me in giving a warm virtual welcome to Professor Dr. Muhammad Kabir Hassan. Professor,
Yes, Maklum down here.
the floor is yours.
Sekejap je, Maklum banyak kerja ni.
Dr. Azlina. Well, Assalamu alaikum wa rahmatullahi wa barakatuhu and good morning, early Saturday morning. I hope all of you are from bed, woke up from bed. Anyway, so let me share my slides with you, and in order to keep our focus sharp to the presentation and to what I want to say, I will be pretty much following my slides so that we can communicate on the one-to-one level. So the title of my presentation is a systematic literature review of risk in Islamic banking system, research agenda and future directions. Now, this paper has recently been accepted in Risk Management Journal, and I have co-authors in this paper, and I'll give you the exact reference at the end of my presentation. So, what is the context again? We know the Islamic finance industry growing very rapidly, and it is, even though growing rapidly, but in terms of the world financial system is probably less than 1%. Now, the number that you see 2019 2.44 trillion, but most recent number is 2022 is about $4 trillion. Now, Islamic banks are different from conventional banks, but both share the same fractional reserve banking system. So even though the contracts are different, but the end result looks very similar to a conventional banks, but they are different in many different ways. And we are going to talk about the risk factor of these Islamic banks. Now, the Sharia compliant business are screened for the degree of involvement of non-compliant activities and financing for conventional sources. You know that any financial product has a moral filter as well as a financial filter. So the moral filter is that a bank cannot give a financing facility to an entity which involves in haram activities. And also, we look at the financing activities, certain financial ratios must be met. So it cannot be a debt-driven industry. For example, its debt to asset ratio cannot be more than 1/3. Now, IBS encounters risks similar to conventional banks and unique risks related to Sharia compliance, market benchmark, and displaced commercial opportunities. Now, what we do in this survey, we review the 6-dimensional Islamic bank risk management, stability and resilience, risk-taking behavior, credit risk, Sharia non-compliance risk, liquidity risk, and other issues. The 4 research themes identified: regulation and governance, risk-taking behavior, macro-social environment and sustainability, and technology and cybersecurity. So we also create 2 risk dimensions of framework. One is called micro framework, internal and external risk factors influencing core process and risk feedback system of the bank, and the macro framework, exogenous, institutional, domestic endogenous, and global endogenous factors shaping the risk management environment for the Islamic banking industry. Now, what is the research methodology that we follow? So, of course, we follow a systemic literature review, and these are very common. Now, we also do a critical analysis of contemporary literature risk in Islamic banks in a systemic way. So, this is our 5-stage systemic review methodology. First, we start with a conceptualization and origin of key terms. Then we define the review scope. Then we come to a systemic literature search. In the 4th stage, we analyze and synthesize the literature. And finally, we share the findings and implications. So the conceptualization, the section 3 conceptualizes of our paper the fundamental principles of Islamic banking risk management. Basic terminology Islam banks area are defined through broader definition, and definitions are cited mostly from journal articles checked with books for consistency. 6 internal integrated components of systemic review we consider: focus, goal, perspective, coverage, organization, and audience. So if you look at Table 1, the review scope. So when we talk about focus, we look at theories, method, and outcome of research. And for goal, we look at the integration with a critical view. Organization, we look at evaluative with a conceptual view. Perspective, non-modified, naturally engaging. Audience, academicians, industry participants, and coverage, representative and very exhaustive. So the systemic literature search and inclusion criteria. So it's a non-repetitive search method we adopt. I'm sorry. Using major scholarly databases. And we have 6 criteria we consider during the search process. Now, our literature search starts from 2010, we end with 2020. So you might ask why 2020? Actually, you have written this paper almost 3 or 4 years ago. I mean, right by the 2020, then it was sent to a journal. It has been under review process for the last 1.5 years. Now, 4 most distinguished databases we choose: Science Direct, Science Direct, Emerald, EBSCOhost, and ProQuest. Only peer-reviewed journals we considered. Articles published in Q and Q2 percentile of Scimago Journal Ranking 2018 are used in order to select papers. Keyword matching search process was used. Keywords selected from reading of risk management process of Islamic banks. And finally, we analyzed 80 articles through this filtering process. So if you look at some sort of how our article selection process started. For example, the search terms, we have the Islamic banks, Islamic finance, risk management, risk in Islamic bank. Then also we end for each of these, for example, Islamic finance and financial activities, financial service, banking. If you look at the third column manuscript before filtering, like Islamic banks, we came up with 1,981 articles. And out of this, EBSCOhost 5, Emerald 12, ProQuest 2, Science Direct 16. And after we filter them through our process, is only 35 articles survive, which we look at very critically to come up with different research clusters and questions. So here, the manuscript number based on Brock et al. So you have, 2 in 2020 is 16, 2019, 12. So the table 2, if you look at the Islamic banks as the most common keyword in academic papers, but not all of them are focused on risk management. Papers below Q1 and Q2 are filtered out, and only those with a core interest in risk management are considered. After applying multiple filters, a final selection of 80 manuscripts was chosen for the systemic literature review. And section 4 in our paper present a synthesis of the 80 selected papers using content analysis. And these papers mostly are coming from Muslim countries, OIC member countries, MENA, GCC, South, and Southeast Asia. Now, let's look at the conceptualization of Islamic banking and its underlying risk. So, what is the definition? So, Islam integrates economic activities with religion through Sharia law. Islamic banking is defined as a financial institution that adheres to Sharia principles and bans the receipt and payment of interest on its operations. Prohibited activities in Islamic banking include interest, gambling, ambiguity, complex derivatives, short selling, excessive risk taking, and business related to tobacco, alcohol, pork, pornography, casino, and weapons. Prescribed activities include almsgiving, sharing profit loss activities, productive use of money, fair transactions, clear consequences of contracts, and trading goods and services. The two most commonly cited factors distinguish Islamic banks from conventional banks are riba and profit and loss sharing. Sharia-based banks adopt alternative contracts based on trade, leasing, and partnership to avoid ambiguity, gambling, and financial derivatives. Equity and economic justice principle of Islamic banking require sharing profit and loss with the borrower. PLS principle based on Mudaraba and Musharaka contracts is viewed as a unique characteristic of Islamic banking. So here are some of the definitions that we extracted from different papers. So for example, Gearhart and Well, they are two Western scholars, they define Islamic finance as the Islamic finance replaces interest with profits and loss sharing, where both parties involved are required to share profit and loss. Like for example, Bhatt and Aftab, two Muslim scholars, Islamic banking system stands on the values and principles of Islamic system that include equality, morality, and trust, among others. And Imam and Kabir, Islamic banks follow Islamic Sharia while offering financial services to their clients. So risk in Islamic banking again. So Islamic banking faces risk similar to conventional, and the risk management practices are primarily proactive in nature. The first line of defense is prohibition of excessive risk taking or gharar. The debt-based instrument and speculative derivatives are generally not allowed in Islamic banking, and Sharia restrictions on the selection of the investment sectors such as alcohol and pork can lead to poor portfolio diversification and higher concentration risk. Can you hear me? Hello?
Yes, we can hear you.
Okay. So the prohibition of interest limits the flow of financial resources and can lead to excessive volatility, bankruptcy, and eventually demise of Islamic bank. And Islamic bank, like conventional banks, faces equity investment risk, credit risk, and market risk. And Sharia compliance risk is unique risk with the Islamic financial system. And this system is exposed to several risks that fall under four broad categories: business risk, governance risk, financial risk, and treasury risk. So here, the risk in Islamic banking system. So risk, you have business risk, governance risk, and hybrid risk. With the hybrid, you have the financial risk and treasury risk. Let me look at it's a little bit small, but if you can read the contract in Islamic banking financial institutions, you have different types of contracts. So you have the intermediation contract and you have the transactional contracts. Under the intermediation contracts, you have the Mudaraba, you have the Kafala, you have the Amana, you have Takaful, Wakala, and Joala. From the transactional contracts, so you have the miscellaneous Qardul Hassan, it's a truly an Islamic financial instrument. Then you have asset-based securities. These are also can be divided into two parts. One is based on trade financing, like Murabaha, Buy Salam, and Buy Muajjal. And the collateralized securities, for there'll be two types, Ijara and Istisna. And of course, the pure form Islamic finance, probably, according to me, is equity participation or Musharaka. So if you look at typical traditional Islamic financial institution, so you have the asset-based trade finance, and it is funded by demand deposit, and that goes under the typical commercial banking or Murabaha banking that we see in conventional banking space. And it is another part which we call investment banking. So you have Mudaraba, Musharaka, syndication. Then it is financed by investment accounts, Mudaraba accounts. Yes, demand deposit can be on the basis of Wakala, but the investment deposits are basically based on Mudaraba deposits. Then you also have the special accounts capital, and you have the fees-based income and underwriting. So if we look one more time, the risk profile of Islamic financial institutions. So you have transaction risk, you have the credit risk, you have the market risk, and market risk have two different components, the markup risk and foreign exchange risk. And business risk, it has the distressed commercial risk, withdrawal risk, insolvency risk, treasury risk, asset liability management risk, liquidity risk, hedging risk. Governance risk has operational risk, fiduciary transparency and systemic risk, business environment risk, institutional risk, and regulatory risk. So let me go over this risk component. Actually, I'm borrowing the slides from one of the World Bank papers. So there are different players into this risk management ecosystem. You have the bank, you have the shareholders, you have the demand depositors, and you have the investment depositors. When I say investment depositors, is the Mudaraba deposits. So the credit risk, how do you define? The credit risk is failure of counterparty to meet his or her obligations timely and on the agreed terms of the contract. The bank faces counterparty risk in the various forms of contracts such as buy muajjal, mudaraba, musharaka, murabaha. Now, demand depositor, they face the risk that the bank does not honor requests for withdrawals at the face value. Investment risk, investment depositor face the risk that the bank does not honor requests for withdrawals at the market value. Then comes the market risk. The market risk is the risk associated with change in the market value of held assets. The first one is markup risk, is the risk of the divergence between Morabaha contract markup and the market benchmark rate. You know, the LIBOR will be discontinued soon, and the Islamic finance industry trying to come up with an alternative to Islamic alternative to LIBOR. And I am heading in working group at the AUFI to come up with the new method which can be used by the Islamic finance industry. Foreign exchange risk is the risk of impact of exchange rate movements on assets denominated in foreign currency, and this exposes the bank to risk associated with deferred trading transactions. And for the others, they have risk, but not directly, we can show in this tabular format. So let's look at the business risk. So business risk results from competitive pressures from existing counterparties. So you have under the business risk, displaced commercial risk is a risk of divergence between assets performance and expectations for returns on liabilities. Now, if you look at from the bank's perspective, the displaced commercial risk may adversely affect the value of the bank's capital. Return on equity will go down, and the shareholders are exposed to the risk of not receiving their share of the bank's profit. And also similar, like the shareholders of the bank, investment depositors also have to forego receiving their moderate share. Withdrawal risk, where the bank is exposed to the risk of withdrawal of the deposits, or in typical jargon or parlance, we call this is disintermediation risk. Withdrawal risk exposes the bank to liquidity problems and erosion of its franchise value. Then you have the insolvency risk, is the risk of bank's failure to meet its obligation when they fail due. And the bank's perspective, insolvent risk may expose the bank to lose of its reputation. And the solvency risk exposes the different stakeholders to counterparty risk, both shareholders, regular demand deposit holders, and investment deposit holders. When you look at the asset and liability management risk, asset and liability management risk is a balance sheet mismatch risk resulting from the difference in terms and conditions of a bank's portfolio on its asset and liability side. Now, from the bank's perspective, this may adversely affect the bank's capital. Liquidity risk is a risk of the bank's inability to access liquid funds to meet its obligations. And from the bank's perspective, the bank is exposed to risk of failure to honor requests for withdrawal from its depositors. And from the wadia or demand depositors, they face the risk of not being able to access their deposits when they need to. Then you have the hedging risk. The hedging risk is the risk of failure to mitigate and manage the different types of risk. And of course, this increases the bank's overall risk exposure. So in the context of this liquidity risk, hedging risk, the Islamic financial industry has to come up with Islamic counterpart to conventional risk management tool. And that's where the researcher, students, and professors can come up and give us the solution to the Islamic finance industry. Now, what is operational risk? Operational risk is the risk of failure of internal process as related to people system. And here, the bank incurs losses due to occurrence of that risk, hence may fail to meet its obligations towards different stakeholders. And from the shareholders' perspective, it may adversely affect their return on equity. And from the investment depositors' perspective, also can affect their return on assets. Fiduciary risk. Fiduciary risk is the risk of facing legal recourse action in case the bank breaches its fiduciary responsibility towards depositors and shareholders. Risk of loss of reputation. From the bank's perspective, legal recourse may lead to charging the bank a penalty or a compensation, and this may lead to withdrawal of deposits, sale of shares, bad access to liquidity, or decline in the market price of shares listed on the stock exchange. So, it is also true for conventional banks. The fiduciary risk is very huge. So, bank has to manage from asset and liability side or asset liability management properly, not to fall into this trap. Transparency risk is a risk of consequences of decision based on inaccurate or incomplete information, which is the outcome of poor disclosure, and losses may occur as a result of bad decision based on inaccurate or incomplete information. Now, business environment risk. Business environment risk is the risk of poor, broad institutional environment, including legal risk, whereby banks are unable to enforce their contracts. And from the bank's perspective, this business environment risk increases its exposure to counterparty risk as weak contracts are not easily enforceable. Institutional risk is the risk of divergence between product definition and practices, and there are a number of lawsuits against different Islamic financial products in different jurisdictions and courts all around the world. Institutional risk exposes the bank to counterparty risk due to the unsettled nature of the contract, and regulatory risk is the risk of non-compliance with regulations due to confusion, bad management, or mistakes. Banks may be penalized for non-complying with the rules or regulations. It could be an issue with the regulatory supervisor, and we have seen in different countries the regulators come down of Islamic banks to shut them down because they are not following the precepts of Sharia. That happened in Turkey, that happened in the UK, and other countries as well. So, one of the regulatory vision of the Islamic financial industry, if you look at the asset and liability of an Islamic finance, there are part, the asset-based or trade financing, we call this. So this type of asset has the minimal risk, and that should be financed by depositors which are look for short-term minimal risk security. Then the middle one, we have the Ijara, Sisna, and Mudaraba, and it has low to medium risk, and this should be financed by the depositors or the segment of investment depositors who are have the stomach to bear this risk. And the third segment is Musharaka, Mudaraba, venture capital, private equity, and that should be financed by long-term investment depositors because these are the most riskiest of all the assets in the Islamic finance industry. Now, we have gone through all the different types of risk and explained them very carefully. So we highlighted those important dimensions in this the last 3 or 4 slides. So now here, when we look at the dimension of the risk again in a summary form in Islamic banking, so profit loss sharing is unique but diminishing in practice due to complexity and cost. So there is a criticism of Islamic banking industry that is behaving more and more like conventional banking or short-term banking or murabha banking. Islamic banks face some unique risks that are absent in conventional banks. We already know this because of the contracts are different. Sharia guidelines imply multiple layers of check and balance in Islamic risk management, and a balance of religiosity and efficiency will determine the performance of Islamic banks. And we also mentioned the articles which touch or discuss these different dimensions of the risk in Islamic banking. Now, Islamic scholars are divided on the commodity riskiness of Islamic conventional banks. Market risk is similar for both Islamic and conventional banks, while Sharia compliance risk is unique to Islamic banks. Islamic banks are less exposed to external shocks compared to commercial banks due to Sharia monitoring on risk-taking behavior, which also makes them less vulnerable to the insolvency risk. And Islamic banks are susceptible to liquidity risk during market-wide liquidity crunch, while conventional banks generally do not face this risk. Now, depositors of borrow Islamic banks are more loyal due to the religiosity or loyalty hypothesis, which has a positive impact on political and economic risk of Islamic banks. And PLS Islamic Financial Service work as a built-in proactive layer of risk management. And religious motivation of customer leads to fewer default cases, but this can be criticized in the absence of a proper risk management environment and asymmetric level of general Islamic banking knowledge of the customers and bankers. So here we have the key dimension of risk management Islamic banks. What we do here, we look at stability and resilience, risk-taking behavior, credit risk, Sharia-related risk, and liquidity risk, and finally the other risk. So let me, instead of going through all of this, line by line, let me share what I mean, what we have done in this part. For example, if you look at size, which is measured by capital, there is a number of papers that were done by Trade 2017, Sihak and Hesse 2010, Ali and Pua 2018. And what are the key findings when you look at the capital or size of the bank? So bank size and capital are positively connected to a bank's profitability, stability, and risk management capacity or capability. Relatively smaller Islamic banks are financially stronger than small-sized commercial banks and larger Islamic banks, while larger Islamic banks are financially weaker than larger commercial banks. When you look at the stability dimension in a dual banking system, there are Abdifar, Gudiki, Hassan 2017, Islamic banking windows are found to be least resilient, highly correlated with market movements, and are most vulnerable to a financial risk. If you look at, for example, bank efficiency default risk, there's a paper by Syed and Ijald in 2016. The commercial banks with a lower risk of default experienced a lower level of efficiency. There exists a trade-off between efficiency risk, and Islamic banks, however, found the same negative connection between profitability and default risk. And finally, if you look at another one, like risk of failing and financial stability, a paper written by Papas 2017, in terms of risk failure, Islamic banks are much safer than conventional banks. So let's look at the second dimension, risk-taking behavior. Following the last slide, let's go over few of them. So the focus area, the first one, the bank lending, deposits, and risk-taking in times of crisis. A paper by Ibrahim and Rizvi 2018, the financial crisis negatively affected the financing supply of commercial banks while it did not have the same impact of Islamic banks. If you take, for example, competition and risk-taking behavior, there's a paper by Alam et al. 2019, and it says competition negatively impacted risk-taking behavior. Actually, it should be competition negatively impacted the risk-taking behavior of Islamic banks, even though the same had a positive connection with the risk-taking and overall banking system. If you take, for example, a governance, risk-taking, and financial performance, the paper by Molla 2017, and it says while maintaining higher capitalization compared to commercial banks, Islamic banks have a governance structure that allows them to assume more risk and upgrade their performance. And finally, the last one, if you look, volume of investment deposit or capitalization, a paper by Hamza and Sadakui 2013 says investment deposit and capitalization are negatively connected because many people say investment deposit sort of act as a cushion like a stockholders equity to guard off the risk on the asset side. Number three dimension, the credit risk, again following the previous slide. So if you look at, for example, the second one, credit risk in Islamic banks in Malaysia. There's a paper Lasud in 2018. The Islamic banks in Malaysia are less stable compared to commercial banks, especially when credit risk is taken into consideration. If you look at default loans, for example, in Pakistan, there's a paper Bayal 2014. Default rate of loans in Islamic banks is half the same with loans from commercial banks. If you look at the financial structure, bank liquidity risk in Malaysia, Abdul Rahman et al. Liquidity risk in Islamic banks in the short and long term depends on their extent and stability of real estate financing. Finally, if you look at the SME loans, financial condition of banks, Hassan and Disley, for Islamic banks, bidirectional negative position of running between SME lending and NPL growth. So let's look at Sharia related issues, number 4 dimension, Sharia non-compliance risk, we call this. So the Sharia non-compliant risk and governance, Bashiruddin and Ahmed 2019, a paper, and the key findings of this paper is banks with a qualified board and especially qualified number of Sharia board experience lesser non-compliance risk. And we are not surprised by this result. And Theory and Sharia Risk, Noor et al. 2019, complying with the characteristics of the contractual obligations is key to reduce non-compliant risk of Islamic banks. If you look at ethics, both Islam and Laurici, there exists a reasonable limit of risk-taking because Islamic banks are supposed to be an ethics-based banking or ethical banking. So it should not taking unexcessive risk. So the riba and garar and profit loss sharing, these are the some important terms that we found through our literature search. And finally, the Sharia Supervisory Board, governance structure, operational risk disclosure, LMR et al. 2019 paper says banks with qualified and independent Sharia Supervisory Board, the block ownership and good governance at the national level see better operational discourse. Liquidity risk, and we talked about this before, assessment of liquidity risk. We have a paper 2019, we wrote a series of papers that year, and liquidity stability in Islamic banks are negatively connected. If you look at asset liability management in dual banking system and duration gap, Chatta 2020 wrote a paper and they find the Islamic banks exhibit diversity in the average duration gap compared to the same commercial banks. If you look at the risk and liquidity management, Mahdi and Abbas, high liquidity across Islamic banks and commercial banks help reduce risk. And then finally, if you look at the microeconomy, bank specificity and liquidity risk, the paper by Effendi and Disman 2017, capital adequacy, return on asset influences liquidity risk in Islamic banks. The financial expansion, financing quality, and non-performing loans affect liquidity risk across Islamic banks and commercial banks. And finally, we have the other type of risk. For example, if you look at the benchmark, net worth risk, duration gap, and stress testing, Chata and Al-Habshi 2018, they wrote this paper. They showed the shock of change in the benchmark rate will be stronger on Islamic banks compared to conventional banks. One of our paper, capital adequacy ratio stress scenarios in Turkey. This is a case study with the Turkish Participation Bank. It came out in Borsa Istanbul Review. And we find that reduced capital reserve for participation banks in Turkey compared to commercial banks in Turkey. If you look at displaced commercial risk, Tommy et al. 2019, they created a model and they find the model inconsistencies explored while studying the values of DCR, value at risk, equity with that of values required by commercial banking system and Islamic financial industry. And then if you look at one more, that Islamic financing, key economic and financial variables, Malaysia, Ibrahim and Sufyan 2014, changes in real output and price level shocks have a significant impact on Islamic banking. So others, if you look at another one, for example, risk management practice of Islamic banks, Rosman and Rahman, experience, type, and size of Islamic banks who differentiate the management of equity investment risk. If you look at ownership structure and DCR, Daher et al., Islamic banks and private sector will use their capital buffers to safeguard the shareholders from selected shareholders from displaced commercial risk. And finally, tail dependence, risk exposure, diversification potential, GCC region, Hernandez et al. Diversification of risk the risk minimization strategies across the commercial banks follow the optimal portfolio model. So these others are more dealt with secondary data and with high level of econometric work. And finally, coming how to synthesize the selected literature. So selected studies fell into 6 categories as I mentioned previously in table 5: stability and resilience, risk-taking behavior, credit risk, Sharia-related issues, liquidity risk, and others. So out of 80 papers, if you find that the highest number of the papers falls under the stability and resilience, with and about 24%, while 9 discuss Sharia assets, Sharia-related issues like 11% of the papers. Now, stability resilience quickly. Studies Islamic banking have focused on financial stability, default risk, political risk, insolvent risk, and market power. Table 5 show the past authors have compared stability resilience between conventional and Islamic banks. The preferred area of investigation has been financial stability strength, but approaches vary. And the researcher reported that leveraged small IBS are stable while managing credit risk in banks with highly Muslim populated countries. Now, if you look at the risk-taking behavior of Islamic banks, the third largest group of reviewed papers discussed in the risk-taking behavior are Islamic banks. The studies reported diverse risk-taking behavior across regions, ownership structures, different instruments, and banks' financing style. Other emerging topics included displaced commercial risk having implication for regulatory environment and pricing techniques, risk-taking behavior in the dual banking system, capitalization in terms of regulation, and ownership concentration, and banks' risk appetite in profit and investment account. The credit risk, several papers investigated that, and these papers find a lower default rate strongly connected to banks being Islamic and contracts being partnership based. So this is what we're supposed to get in an ideal Islamic banking ecosystem. Economic growth, growth of loans, and growing bank size and profitability will help reduce the proportion of non-performing loans in emerging countries. And Islamic banks are found to be more vulnerable to credit risk than commercial banks. If you look at the Sharia non-compliance risk, the reviewed papers also looked at the Sharia non-compliant risk, and what are the Sharia non-compliant risks is commonly associated with the contractual agreement. So is the contract that does violate the different conditions of Sharia. Effective management of board size, board independence, expertise of board members, and good governance culture can help manage non-compliance risk. And efficient disclosure practices are essential for establishing a strong governance culture. Liquidity risk, the papers that we've discussed, the Islamic banking system was found to create more liquid than conventional bank. So we used to say the Islamic banks suffer from excess liquidity because they do not have, or the banks cannot find an Islamically compliant businesses they can make the financing facilities to. Factors affecting liquidity risk in Islamic banks include capital adequacy ratio, financial expansion, financing quality, and non-performing loan. And the liquidity risk of commercial banks are determined by financial expansion, financing quality, non-performing loan, and return on asset. And if we look at the others, 18 out of the reviewed was 22% were multidisciplinary in nature. And these are the others one, as I said, these papers dealt with the secondary data, and these papers covered various dimensions of Islamic banking risk, including displaced commercial risk, interest rate risk, stress testing scenario, Islamic hedging instrument, voluntary risk disclosure, and risk management tools. And the risk research topic represent two extreme research and policy interventions: data sensitive modeling and qualitative disclosure. So data sensitive modeling deals with secondary data, and qualitative disclosure deals with mostly collecting primary data through survey based techniques. Now I'm coming towards the end of my presentation, concluding discussion. The summary of 76 empirical manuscripts in Q1 and Q2 journals on Islamic Bank risk management. Actually, it should be 80, not 76. Review suggests that risk management Islamic banks lacks a complete framework, multi-dimensional research topic, report diverse impacts of risk management system, culture, and practices. Majority of the studies compared conventional Islamic management, but theories underlying this area are yet to be fully examined. Now, we should take a multidisciplinary approach when we study Islamic banking industry. Future investigation should focus on prudential regulation, risk management environment and sustainability, data-centric risk analysis and cybersecurity, and acceptable risk-taking behavior. So if we put this, the agenda for the risk in Islamic banking system, research topics like effective and simplified risk management, increase financial stability and resilience, reduction of default loans, prerequisite of risk-sharing finance, disclosure and transparency policy, early warning and risk prediction, better investment portfolio management, strong credit risk management, positive financial outlook, risk shifting versus risk taking, and you can put them in 4 different research themes like prudential regulation, Islamic governance, macro social environment and sustainability, technology and cybersecurity. This is a growth industry, and the researcher, I invite them to do more research in this area. Capital structure and risk-taking behavior is a very widely researched area as well, but still there are a lot more work to be done in this area. So, emerging themes, collaboration is the key. Figure 5 summarizes research topics from reviewed manuscript to explore new themes. 4 research themes are proposed: prudential regulation, Islamic governance, capital structure and risk-taking behavior, macro social environment and sustainability, and technology and cybersecurity. And the prudential regulation Islamic governance is an important as capital structure and risk-taking. There are grounds for collaboration between banks and regulators for efficient risk management. Regulatory and institutional cooperation expected for Islamic governance, cybersecurity, sustainability, and risk-taking behavior. The regulatory and governance issue of profit and loss sharing accounts will be a significant issue for Islamic bank survival in the future. So we also look at the micro and macro framework of risk in Islamic banking. So here I want to share you what we mean by this, a conceptual micro framework for Islam risk in Islamic banking. So if you see the external factors on the left-hand side on my screen, the economic factor, recession, inflation, political stability and governance regulation, social culture and values, changes in market dynamics, like, for example, competition. Now the core process, so you have the deposit client, fund will flow of Islamic bank, and the investment client, and the internal factors in new resource and technological capability, corporate culture and Sharia, governance and internal control system, and the risk-taking behavior. Now, when you do this, the conceptual micro, and if you look at the conceptual macro framework of risk-taking in Islamic banking, so you have the global context and international standard risk management generalization. We call this endogenous global, cross-country comparison, Sharia compliance, theory, creation. Then if you come inside the endogenous domestic, is domestic environment, bank regulator relationship, systemic risk. And if you look at exogenous factors, the exogenous are coming risk specific, banking, Islamic banking principles, limited coverage data, micro risk management, contractual compliance, risk management in instruments. So what I'm trying to tell you is that you need to have a focus what you want to do. For example, what will be the agenda, what are the research teams you're doing your research. Then you have to look at in a sort of holistic way what is the conceptual framework for the micro sense and conceptual framework for the macro sense. So these are the papers that we have analyzed 27 in order to collect data Q1 and Q2, and these are some of the references. We have a paper that has been mentioned many times in the literature. I have a textbook, and we also recently, as I said, this presentation is based on a systemic literature review of risk in Islamic banking system that is coming out in risk management, was accepted on November 7, 2023. So that concludes my presentation, my dear friends. So I'm open to any questions that you may have.
Thank you, Prof. Kabir. I think there's one question in the chat box.
How do I open the chat box? How do I get chat box? Can you read it?
Yeah, let me read it.
Uh-huh.
As you mentioned, the PLS seemed less preferred by IFIs. Does it mean the IFIs are no longer stuck to the fundamental establishment of IFIs to be involved actively in real economic activities rather than merely giving out borrowing on the pretext to avoid high risk exposure? Your opinion, please. This question is by Associate Professor Dr. Amirul Afif.
Okay, excellent question. I think, Prof, you already know the answer. First of all, we cannot really get the essence of Islamic finance through a banking model. And banking model is deficient. It's not in Islamic bank. In conventional banks, we also have the same criticism. That's why there's a Chicago school called that the banking should be separate in two parts. One is called narrow banking, which will be done by the transactional deposit 100% reserve requirement. And then the other segment would be the investment banking, which will be supported by long-term investment deposits. Now, since the one of the no-no is riba, that is not allowed, now Islamic banks have taken a conventional fractional reserve banking model, and it also creates a deposit in the same way as conventional banking model does. So the answer is, in the Quran, Allah says, riba is haram and trade is halal, but there is no mention that give me a bank, and it is our human construct. We have come up with this model. When our forefathers started the Islamic banking movement 50 plus years ago, they, without thinking, adopted a fractional reserve banking model, which by itself cannot really, or it goes against the spirit of partnership type of financing of Islamic finance. So in order to achieve what you just suggested, we need to do it through a non-banking financial mode. Like we can have venture capital, we have the Modaraba companies, long-term investment, mutual funds, and also need to bring the Islamic social finance within the picture so that we have a marriage between Islamic commercial finance and Islamic social finance to get the objective or maqasid of spirit of Islamic finance. Until that happens, the question that you asked me, brother, we will face this question again and again. Islamic banks cannot do it, and we should not force it to do it. If we force the Islamic bank to do it, is going to end up with a failure, because the conventional or the Islamic fractional reserve banking system is not capable of handling a high level of risk. It can only handle collateralized lending or lower level of risk that we have seen. Okay, there's another question. Assalamu alaikum, Prof. I missed it again. Can you read it, please, Azlina? Can you
Yes, Prof. Why it is difficult for Islamic banks to satisfy the Basel III liquidity coverage ratio (LCR) requirement? This is by Professor Sharifah Faika.
Okay, liquidity risk management. First of all, Prof, the one of the biggest criticism that we have in the Islamic banking industry, not Islamic finance in general, that we have a lack of Islamic or Sharia compliant liquidity instruments. So that creates a fundamental problem for Islamic banks come up with enough liquid instrument that it can put up as part of this equation that you mentioned, the Basel III liquidity. There are two types, I forgot this. So one is very core liquid, the other one is long, so short term and long term. So that really plays a role. Now the question is, many people are coming up with different solution. One of the solution like short term sukuk, liquid sukuk, the government investment securities, those kind of solutions are being put forward. But until we put more our resources and coming out more or Islamic money market instruments, that liquidity buffer that we talk about from the perspective of Basel III, very difficult to maintain. And since you work yourself as a Sharia scholar in the banking industry and you face that the problem, and you can see, but so you have to advise the younger scholars, how to come up with these different Sharia compliant short-term money market instruments that can fulfill this liquidity requirement of Basel III. Forget about Basel III. Even for the banking perspective, we need to have those instruments.
Okay, thank you, Prof. Are there any more questions from the audience?
Okay.
Yeah, there's one more. Wow, quite a long question. Two questions, actually. Let me read the first one. This is by Anggi Aprizal. He is from the University of Yogyakarta, Indonesia. A student of Master of Economics, I think. Yeah. So the first question, in searching journals, how do you determine keywords and topics, whether based on previous articles or how? Okay, that's the first question. The second question is related to financial stability and resilience in Islamic banking. The issue of resilience is starting to be talked a lot back after COVID-19. What distinguishes resiliency and stability in the financial system? Whether you agree before financial stability occurs in need of resilience first.
Okay. The first question is, when you write a paper, you have to know the spirit of the paper, and you can look at other similar papers that you mentioned in reference to find what will be the appropriate keyword. So this is what I do myself. And I had a presentation instead on different dimension of banking that I talked about the keyword search is important when you do bibliometric analysis. The second question is more fundamental. The question is, what is stability, right? The stability, there are different, conceptual definition, of course, is that the system runs properly without getting into trouble. But the question is, how do you measure it? So you know that value at risk, distant to default, there are a number of proxies that have been developed in order to measure stability in the banking industry, whether it's a conventional or Islamic. But the problem that we have in order to do this type of studies, the data, secondary data. Now, Islamic banking industry is very non-transparent in terms of data. We get a lot of data from the conventional one. Now you ask which one is first. Resilience. It's a chicken egg problem. I would say my take on this thing is Islamic banks, if you do it Sharia based banking, it will be more resilient to the risk. Yes, it's a risk taking, but it's a risk sharing technique. Because of the risk sharing technique, it creates more stability into the system than destabilizes it. One of the main criticism of conventional banking, that risk sharing is not proportional. That means one party is taking more risk than the other party. So that resilience point of the word that you mentioned is less in conventional than in Islamic. So if you follow the Sharia-based banking, it will be more resilient, and of course, more resilient to risk. That means the banking system or the stakeholders of this industry will not get into a high risk-taking or disproportional risk-taking behavior, excessive risk-taking behavior that will naturally lead to a stable banking system. Next question. Hello. One question for me. Okay, Dr. Ashraful Haq. Yes, please.
Assalamu alaikum, Prof. You mentioned one time that Islamic banking can be vulnerable one time, and right now you're saying it can be resilient. So I need some clarification. Thank you, Prof.
Okay, very good. So yes, it could be vulnerable in a dual banking system because it's trying to compete with conventional banks, and the conventional banks is a 400 plus years old, and it has perfected its different risk management techniques and so on. Now you see one of the problem that we face, brother, when you talk about risk management in general in Islamic banking, we are using a conventional banking risk management tools for Islamic banks, right? So that leads to my question, it could be vulnerable, but if you do a paradigmic Islamic finance, Islamic bank, in general, it will be more stable than vulnerable. But the question is, we are not really doing the paradigmic version of Islamic bank as the Prof, Arif has asked the first question. So unless we go to that direction, we'll face this dichotomy or contradiction that I just mentioned. So first contradiction is could be vulnerable in a dual banking system because it is not following the tenets or the forms and guidelines of Sharia completely. And the other part, the contradiction that you mentioned, it could be more stable. It could withhold all sorts of risk if it follows the paradigmic or Sharia based banking principles.
Thank you, Professor. Thank you, Professor.
Okay, there's one more question.
What is it?
This question is from Jason C. Many scholars claim that Mudarabah, one of the form of PLS, provides limited control rights to shareholders or blockholders. How does the system affect the interest perspective of the related stakeholder?
I think the question could be rephrased in a better way. So the Mudarabah depositors are not the shareholders of the company. You have to understand. So the limited liability point that you are mentioning, it is faced by only the shareholders because these are the residual payments. Now the Mudarabah depositors are supposed to be the risk sharing or profit sharing or loss sharing, how the contract is designed between the bank and the Mudarabah depositors. And their rate of return, profit or loss, should be based on the performance on the asset side, which is also, that's why we call this the model. Used by Islamic banking industry is called double Mudaraba. Two-sided Mudaraba contracts. So on the asset side, the bank gets into a Mudaraba contract, a partnership with the finance takers. On the source of finance side, the depositors, well, if it is a Wadia short term, they don't, but if it is a Mudaraba deposits, they come into a profit sharing agreement with the bank. So the control right, you are talking about that when you do, you have to be very careful. The Mudarib, in this case, the investment depositors are providing capital to the bank, and the bank is the Mudarib, and investment depositors are Rabbul Mal or capital provider. So in this case, that in Mudaraba framework, they are like the passive investor. They are not supposed to intervene unless the bank is getting into some sort of willful activities. So they have to give and be more freedom to do whatever they do with the money. So the monetary or control or limited the words that we are mentioning, that is not directly under the purview of the Mudaraba depositors. That should be done by the regulators. But having said this, if this Mudaraba deposits, like in the United States, we have this high, we call this negotiable order of withdrawals, which is the secondary market. So the secondary market depositors impose some sort of discipline on the bank. If the bank becomes more risky in the asset side, they withdraw their fund. But within the Islamic banking industry, we do not have a secondary market from Mudaraba depositors. That's why the control or the monitoring or the discipline, the market discipline, is not done directly by the Mudaraba depositors. However, having said this, I have seen a paper or two where the authors try to show that it also happens in Islamic banking industry as well. When Islamic banks become more risky, the Mudaraba depositors take their money away and go to a different bank. So this is in a nutshell to answer your question. It is not 100%. Probably you are happy with it, but this is the best I can tell you.
Thank you, Prof. Any more questions? Okay, if there are no more questions, can we wrap up the session, Prof?
Yes, I thank you very much. So I want you to take a snapshot, or if you watch the video when it comes in YouTube. So these are the papers I want you to read again in order to have a fuller understanding. And I do urge the young scholars to look at the risk dimension of Islamic finance industry from its perspective, not from a conventional finance industry, because conventional finance industry risk management tools are different than what should be used in Islamic finance industry, because the contracts are different. You know, there are two major factors in Islamic banks are very unique. We call this riba and gharar. So, and we need to develop the risk management tools, not just left and right use the conventional risk management tools in Islamic finance industry. And if we do that, we will not be managing risk properly, and that could be one of the contradictory statements that I mentioned, could be a reason for the vulnerability of Islamic finance industry to different types of excessive risk attacks. So with that, I want you to benefit from it and read more and share more knowledge and take the industry, the Islamic finance industry, ahead, in a paradigmic version, so that we get the essence of Sharia, essence of Maqasid, that is helpful to everyone, regardless of religion, because Islamic bank or finance is not only for Muslim, it is for all humanity. Thank you very much.
Yeah, Prof, a few of the audience would like to know if they can have a copy of your slides.
Sure, yeah, they can.
Okay, so get them to contact you, right?
Yeah, they
Okay.
tell them to contact me, please.
Yeah, all right. Okay, thank you, Prof. Thank you, Prof. Kabir Hassan, for sharing your expertise on the systematic literature review of risk in the Islamic banking system. Your insights have been both enlightening and thought-provoking, as always. And to our online audience, we appreciate your participation in this session. So I encourage you to continue the conversation. Do connect with Prof. Kabir and explore further the wealth of knowledge that he shared today. Stay tuned for future events, which will be made known on AAGBS social media platforms. On behalf of AAGBS, thank you everyone for joining us. Until next time, have a wonderful long weekend ahead.
Thank you.
Assalamualaikum.
Assalamu alaikum to everyone.
Waalaikumsalam. Thank you, Prof. Have a good stay in Malaysia.
Thank you.
Thank you.
Thank you, Prof.
Thank you. Thank you, everyone. Assalamu alaikum. Have a good weekend. Okay. I'll see you on, hopefully, to see you another event soon on Tuesday, right?